Hello, good morning, everyone. My name is Rudon Shrestha, and for this week's TQ, we'll be talking about double entry accounting and preparation of the financial statement. So, starting off with accounting. Accounting is a language of business, facilitating systematic recording, analysis, and reporting of financial information. It plays a vital role in decision making versus allocation and performance evaluation. Key concept includes double entry accounting, the accounts and balance sheets, which we'll be seeing in the next slides. So, As its core, at its core, double entry accounting is all about ensuring that every financial transaction has equal and opposite effect on at least two accounts. Let us take a closer look. Here, we can see that we have two sides of the same coin, debits and credits. These are notations used to record changes in accounts. It is essential to understand that a debit isn't necessarily a bad thing and a credit isn't necessarily a good thing. They simply represent different types of changes. Similarly, we have the accounting equation, which states that assets is equal to liability plus equity. This equation always holds true when a transaction occurs. Here, assets are things of value that the company owns, such as cash, inventory, or equipment. An increase in assets is recorded as debit, while a decrease in assets is recorded as credit. Types of assets are current assets. Current, current assets are the assets that can be converted to cash or a cash equivalent within the space of 1 year. They are also referred to as liquid assets. Owing to the importance of the business liquidity, cash, its example are cash and cash equivalents and account receivables. Similarly, there is fixed assets, which are assets that cannot be converted to cash or cash equivalent within the space of one fiscal year. They are also referred to as non-current assets or long-term assets. Its example includes real estate and patents. Similarly, there is tangible assets, which are assets with some kind of physical presence, such as real assets, cash, office supplies, vehicles, etc. Similarly, there are intangible assets, which are assets that aren't physical but offer long-term value to a company. Some examples are trademarks, brand recognition, goodwill, research and development, and patents. Similarly, liabilities are the obligation or debts that a company owes, like loans or accounts payable. An increase in liabilities is recorded as a credit, and a decrease in liability is recorded as debit. There are two types of liabilities, which are long-term and current. Long-term liabilities are payable after a period exceeding 1 year, for example, owner's capital or bank loans, and current liabilities are payable within a year or in a day-to-day course business, for example, creditors or payables. While there's equity, which represents the owner's or shareholders' interest in the business. When an owner invests more capital into the business, it's recorded as a debit to equity. When the business generates profit, it's recorded as a credit to equity. Losses, on the other hand, are recorded as debits to the equity. Now, there's T account. T account is an informal term for a set of financial records that uses double entry bookkeeping. The term describes operands of the bookkeeping entries. At the first or last letter T is drawn on the page, as shown here. The T account is a graphical representation of a general ledger that records a business transaction. It consists of the following: account title at the top of the horizontal line, a debit side on the left, and a credit side on the right, as shown below. Here, if for different accounts, debits and credits may translate to increases or decreases, but the debit side must always lie to the left of the T outline, and the credit entries must always be recorded in the right side. For example, if an X and Y company sold $20,000 worth of books, it will debit its cash account by 20,000 and credit its book or inventory account by 20,000. This double entry system shows that the company now has $20,000 more in the cash and a corresponding $20,000 less in inventory on its books. The account will look something which like shown in the figure. Now let's look at trial balance. Trial balance is a crucial component of accounting. It serves as a financial statement designed to verify the accuracy of company's accounting records. Trial balance provides a snapshot of a company's financial standing at a specific moment in time. Its primary purpose is to ensure that debits equal credits, maintaining the balance in the books. Here we have an example of a trial record. As shown in the figure, in this trial balance, total debit amount 6,500 equals to the total credit amount 6,500, indicating that the books are in balance. Now let's look at balance sheet. So balance sheet is derived from trial balance and it provides a snapshot of the company's financial position at a specific point of time. It reports the company's assets, liabilities, and shareholders' equity. To prepare the balance sheet, we classify accounts from the trial balance into the following categories, which are assets, liability, and shareholders. So basically, balance sheet consists of these three things: assets, liabilities, and shareholders' equity. So assets are accounts with debit balances such as cash, account receivable, inventory, prepaid expenses, equipments. Liabilities are accounts with credit balances such as accounts payable. And finally, shareholders' equity is a common stock and retained earning as a part of shareholders' equity. So this is an example of balance sheet. In a balance sheet, this balance sheet provides a clear overview of XYZ company's financial abilities, showing that its assets, liabilities, and shareholders' equity. It ensures that the accounting equation assets equal to liability plus shareholders' equity equals is true, which can be seen as this year's and last year's total value are similar for both the fiscal years. So thank you, and these are the references.